The October 17th debt ceiling deadline is quickly approaching. The Senate Banking Committee came together Thursday to discuss the consequences of not raising that debt ceiling proposal before the deadline.
What we potentially could do is set off a financial chain reaction that would go from market to market to market with unknown and perhaps catastrophic consequences.
If our nation defaults on its nearly $17 trillion in debt, the harm is likely to be measured in hundreds of billions of dollars.
Arguments were made that the effects of a default could be seen through a wide span of the economy.
For banks, which hold $3 trillion in Treasury, agency, and mortgage-backed securities, the sharp decline in value of those securities would translate into fewer resources available for mortgages, business, auto, credit card, and student loans.
And should the Treasury default, the effects would quickly spill beyond the Treasury markets and into the broader economy. Multiple shocks, cash shortfalls for holders of defaulted Treasuries, higher interest rates, diminished confidence, and pressure on the dollar would be likely to undermine economic activity.
Senator Chuck Schumer made it clear, not paying our debt is not an option.
Well, it's safe to say investors have confidence in the ability of the United States to pay its obligations. If that changes, it's going to make our debt worse considerably. Interest rates will go up. It's going to make the country less strong. And I would argue that one of the best ways to increase our debt is to not pay our debt obligations, to not pay our bills.
Over in the House, Speaker John Boehner offered up a short-term proposal that would temporarily raise the debt ceiling until November 22nd. For WashingtonExaminer.com, I'm Lisa Rule.